Welcome to Retirement Unpacked, a weekly podcast by Parallel Wealth. I'm Adam Bornn, and each week, along with our team of experienced financial planners, we'll explore the ins and outs of retirement, from income strategies to taxes, lifestyle choices, and everything in between. Before we dive in, a quick note. What we share here is for educational purposes only. It's not personal financial advice. Everyone's situation is unique, so be sure to talk to a qualified financial planner before making decisions about your retirement. Let's get started. Welcome to episode 11 of Retirement Unpacked. Thanks again for joining us. My name is Adam Bornn. This is Brett Martinson, and we're here to answer your questions. So again, if you have questions, please list that below. And we have an exciting guest coming on in a couple of weeks from now. Dave Chilton, the Wealthy Barber, will be joining us in a few weeks. So make sure to tune in for that then. So Brett, let's jump into the questions here.
Is David Chilton joining us, or are you kicking me out to have David Chilton in? I think it's the other way around, isn't it?
Something like that. Yeah. You're being replaced for 1 week. Yeah. 1 week.
Well, if I got to be replaced, I think David Chilton's the guy. Okay. David Black, 6413, ever grateful for the new series. Thanks very much. Appreciate the feedback. I'm a longtime do-it-yourself investor, DIY, who helps friends and family set up and maintain DI, direct investing accounts with several discount brokerages. This brings me with conversation about what's good and what's less optimal financial products. So David gives the example of, in his opinion, market-linked GICs and segregated funds are not in the category of good products. Too often a common feature among these structured products is that they charge high fees and limit liquidity. And so he goes on to say, in your view, be it for general investing or retirement finance, what makes a good financial product versus a less desirable one? Gosh, I don't want to start with it depends right off the top of the podcast. I want to keep that in my back pocket.
Why not?
Yeah, exactly. So one of the things I often say is I would be happy to pay a 7% MER fee if I feel like I'm getting 10% of value for whatever's going on. So to me, the question is not necessarily about fee. It's about what does the product accomplish for the person? And is it right for what they're trying to do? And has it been fully explained to them, at the very least, the downsides of the product? Like what could go wrong type of thing. So let's talk about segregated funds to begin with here. Segregated funds are similar-ish to mutual funds, except for they're in the Insurance Act space. So they're kind of wrapped with this guarantee and things like that. And whenever we have a guarantee, you tend to pay more. You're paying for the guarantee. Do I see a lot of need for them? I'd kind of have to say no if I had to really make an answer to that. Is there time and places where it's worthwhile to have them as long as they're well explained and why the fees are more and things like that? Yes. So that's my sitting on the fence answer to what makes a good financial product versus a less desirable one. Adam?
Yeah, and it goes back to what we've talked about before, which a lot of people have gone from a full service, say at the bank, paying 2-3% in fees and getting nothing for it, and going to the opposite of, well, I'm paying no fees, but I'm not getting anything either. And I think there's this balance in between. As far as finding a product, yeah, like everything's going to have a fee. Like if you want to get into the alternative space, more mortgages, private debt, there's more cost to running those types of funds. So you're going to pay a higher cost for that. A lot of times it's embedded. You don't even know a lot of the costs. So I think at the end of the day, you have to look at, do you feel like you're getting value? And that's going to be a different answer for everyone. I think for a lot of our viewers and listeners, they're in retirement or close to retirement. And again, this podcast is Retirement Unpacked. To unpack what is a good investment product in retirement, I think it's something that meets your needs. So once you have a retirement plan and know where your income's coming from, do the products or investment solutions that you have, are they able to meet your needs? I.e., are they able to give you the cash flow you need without being tied to the markets? Or are they able to grow your accounts long-term, the money that you don't need for a long time? So, I think we gear into fees a little bit too much, and fees are important. They can eat a lot of your return away. That you have to pay attention to fees. But I think people have said, well, it has a fee, so I don't want it. Well,
Yep.
Yeah, but the returns might be good. The solution for you might be good. It might diversify your portfolio a little bit. So what is a good product? I think a good product or solution for people, especially in the DIY space that, stress about this and lose a lot of sleep over this is it providing you the cash flow and the rate of return that you require to meet your retirement needs? I think that would be a good way to go about finding a good product.
Yeah. And I would probably tap onto the end of that maybe it's less about good products and bad products. Maybe there are no good products and bad products. It's more about how well was that product explained to you? How well did you understand the ups and downs so that surprises don't happen in the future because you were aware of the surprises?
Exactly. Question number 2 comes from Hop Sticky Guy. Thanks, really enjoying the content. I'm having trouble wrapping my head around this issue. If I retire at 60 and no longer will be contributing to CPP, the Canada Pension Plan, in my case, QPP, the Quebec Pension Plan, how does the CPP payout compare to ages 60, 65, and 70? Does the standard advice of delay and increase the monthly payout still apply when the contributions are no longer happening? And I had this conversation with my accountant yesterday, and he was asking me, like, for our business owners, Adam, should we actually be running some numbers at age 53, right? If someone's paid in almost full all the way to 53, they get roughly 17%. Let's call it 7 years of dropout. So let's drop out from 53 to 60 and take CPP at 60. And said, yeah, but we could run that again and again, and it'll still probably make sense to delay. So now you have 60 to 65 of non-contributory years, which is what what was it here again? Hopstick Guy is talking about. So yes, you will have more non-contributory years, but really what it ties into, you have those 5 years, but how many previous years do you have? At the end of the day, if you stop paying in at 60, it will still typically make sense for 99% of people to delay it closer to 70, even though you have those non-contributory years. What Brett and I will consistently say is not that it depends. We will say, go to the CPP calculator that PWL put together. Put in your numbers. Yep. And then it's not guessing. Now, the problem I always have with any CPP calculator is it's taking CPP in a silo. So all you're doing is looking at the decision around CPP. It's not integrating everything else. So step 1 would be go look at the PWL calculator. Step 2 would be talk to your financial planner, hire a financial planner to put a plan together. It says, here are my actual numbers based off PWL. Then integrate that CPP number into the rest of your stuff. And I did a video about 3 or 4 weeks ago now, and it broke that down. Stop paying at 60. Should I take it at 60, 65, 70? And when's that break even point? And when we added in all the other income and assets for that client, the break even point of delaying CPP till 70 was 71 and a half. So only a year and a half after taking it, which is bonkers. But we run into that kind of stuff quite often. So again, get the CPP number, but then actually run it through financial planning software.
Yeah, I agree. And so some of the cases where we don't see with our clients that it makes sense to push it all the way to 70. And when I say it doesn't make sense, mathematically, it doesn't make sense because there's the psychological, emotional aspect of it, is when they may not have enough funds to fund themselves during that period of time. So then it becomes, okay, well, it looks like based on the projection that we should be taking this around 67, let's get back together in a few years when you're closer to that, whatever the case may be. But everything else being equal based on this question, I think Doug Runchy said it best, which is if everything else being equal, if you do defer it down the road, you are just getting a bigger part of a smaller pie. You can't change the size of the pie unless you contribute more and longer. So the pie is locked, but at 62, you get a bit bigger piece of that pie. At 65, you get a bit bigger piece of that pie. At 70, you get a bit bigger piece of that pie. And I've always found that is a great visual for trying to figure this stuff out.
Yeah. And remember, every year you don't contribute. Yes, it does affect the amount you would get at 65. But we've done, when you reverse engineer the 0.6% per month decrease by taking it before 65, if you reverse engineer it, well, from waiting from age, if you're going to take it at 60 and wait till 61, your increase is over 11%. right? So 61 to 62, it's about 10 point something, then 9. And so, it's a double digit, really, it's not a rate of return, but it's an increase in payment for the rest of your life, increase to inflation. So yeah, just because you're not paying into it doesn't mean you should be taking it. So again, run the calculation, then put it into software and figure out what the best solution is for you.
Yeah, absolutely. Okay. Number 3 here. And just a quick shout out to Done by the Real Deal, who made some answers to that last question. I don't know where he got the 56.25% higher at 65 than 60, but we'll talk to Done by the Real Deal.
We'll let them take that offline.
We'll figure this out. Okay, Clover 1, 2, 3, 4, 6. Not Clover 1, 2, 3, 4, 5. That's somebody else. This is Clover 1, 2, 3, 4. Yeah. Is it okay to take a monthly income from your TFSA? A bit of a spelling thing here, but I think what we're referring to is TFSA. Or should you withdraw all you need for a year at once? So should I take, if I need $1,000 a month, should I take $1,000 a month, or should I take $12,000 all at one time? There's really, I'm really having trouble with the "it depends" answer to this time, this podcast. I say in general that it's going to be sitting there. If you're taking money out, it's going to be sitting there in that cash wedge, which once again, maybe cash wedge isn't the best way to stay it, but that call it the safety wedge. I don't know. That if it's already sitting there pretty much in cash or something guaranteed, then I don't really see an issue with taking it monthly versus yearly. The only reason that I would consider taking it yearly is if A, I don't feel I need that money right away, and B, I don't have to wait as long to put that money back into the TFSA if I take it out November 20th, December 13th, or something like that. So if I don't absolutely need it and I can wait and then say, oh my gosh, now I need that $12,000 for next year, then yeah, maybe you just yank it all out towards the end of the year, recapture that contribution room earlier in the year rather than having to wait longer. Other than that, I don't really see a benefit one way or the other. Adam?
Yeah, and I think it depends on what the money's for. Like if it's to pay bills and groceries, well, then monthly is going to make the most sense. Like do it. Yeah. I always say when you enter retirement, try and create a cash flow that's similar to what you had before. So if you were getting paid every 2 weeks, set up your RRIF payments, your TFSA, wherever you're collecting your income from in retirement to match that. Now, if the TFSA is more, well, it's for a larger, it's for my travel or whatever it is. Pull it when you need it. Just make sure you know that, hey, I need $12,000 or whatever the number is this year. Just make sure it's not tied to the markets, because if the markets drop right before your trip, it leaves you in a tough position. So I would say it's not, it doesn't matter, or it's not, it depends. It doesn't really matter. Pull it how it makes the most sense for you. Really no right or wrong answer on that one.
Yep.
The next question is around what age do you recommend starting retirement planning? So this is from someone skid. What are the ages of some of your younger clients? When do you recommend starting retirement planning? So as far as retirement planning, I would say our average client, our team focuses on retirement planning. We don't kind of work with the younger, let's say, financial planning clients. And that brings up a good point. We're here for a second, but The Wealthy Barber, they're Dave's new book. He gave me an early release. It is released out now. So make sure to pick up that. This is a great book for people from, let's say, 18 to 45 or 50, kind of building up that accumulation phase. As far as retirement planning, you want to get a financial plan. You want to make sure you're moving in the right direction at any age, 20 onward. As soon as you start making money, what should you be doing with that? But as far as retirement planning and look at like strategy and stuff, 5 to 10 years before retirement gives you a good runway. If you need to start saving different or accumulating money in different buckets, or maybe you're going to retire, like we've done plans for clients, it's like, 10 years I'm retiring. It's like, well, you could do it in 3. It's like, whoa, okay, well, that changes things, right? So I would say a good timeline is 5 to 10. Our average client, I would say, comes into our office, 1 to 3 years before retirement, if not already in retirement. If you want to kind of get ahead of it, 5 to 10 years, more than 10, there can be a lot of variables still, but 5 to 10 kind of is that sweet spot.
Yeah, and the flip side of that is my daughter just graduated from university, and not that I haven't done a financial plan for her before, but I did the first kind of formal one. Now, like, she is miles away from retirement. So what the heck is the value of that? And as I said to my daughter, I said, the value here is not that these numbers are going to work out exactly the way you see them. The value here is to try to start to determining based on type of work you're doing and how steady you think it's going to be and things like that, of how much you may want to consider saving now versus saving later, and can you get ahead of that rather than being behind down the road. So she may not be able to accomplish everything in that plan right now, and those numbers obviously are going to be wildly different years down the road, but at least it gives a starting point. Again, we use route maps or road maps all the time in terms of, getting in a car and starting to drive west to Vancouver or starting to drive east towards PEI doesn't necessarily tackle all the detail in between that, but at least it gets you going in the right direction.
Exactly. And I always say, like, 5 to 10 years to retirement, get a retirement plan. Focus on retirement, tax, drawdown, the decum. Whereas, when you're younger, I always like to call it a financial plan. So there's a financial plan, and then it transitions into a retirement plan. And your financial plan will look forward into retirement to make sure you're actually making the right steps. But it's really, up until that 10-year mark, you're really focused on, like, what's really important the next, say, 2 to 5 years, maybe up to 10 years of, like, what are the action points I need to do? So more financial plan. And then again, as you get closer to retirement, really focus on the retirement plan, like the actual decumulation. How am I going to draw this down? When can I retire? How much money can I have? Am I saving in the right buckets, etc.? So,
yeah. And there's some great financial planners out there that focus, as we focus on retirement planning, or 5 to 10 years before retirement. There's some that only focus on early parts of the career and that aspect of the career, and they don't necessarily focus on the retirement planning. So there's a financial planner out there. Yeah. I was going to make fun of you for not saying the last person's name correctly because it's someone's kid, but now I've got this one, which is Debashtity 4111. So now I can't say anything about you. Adam and Brett, thank you very much. Brett and Adam, actually, when you put in the questions, let's have it Brett and Adam. Adam, does leveling out the tax ignore the opportunity cost, or should I say benefit, of paying less tax early in retirement? Tomorrow's $100 is less valuable than today's. And absolutely, tomorrow's $100 is less valuable than today's. So a couple of different ways, I think, to look at this. One is when we talk about leveling out the tax, we are mainly talking about leveling out the ratio of the taxes paid to the taxable income at a very high level. So why am I mentioning that? Because if we assume that your taxable income brackets increase by inflation each year, and by leveling things out, if you were to look at a taxes paid graph, it may look like it's kind of going up towards the end or going down or whatever. But the assumption there is, if we assume tax brackets are continuing to move up slightly with inflation like they have in the past, then we are actually leveling it out. The other aspect of that is it's never going to be perfect to level it out perfectly. And what's going to happen 3 years from now when you sell a capital gain or something like that is going to adjust how you're going to make those changes. So I can't really say it's ignoring the opportunity cost. I think it is looking at it, but it's also recognizing that even if we are ignoring the opportunity cost of that it's no more money left on the table than anything else that you just can't predict that far into the future. Does that make sense, Adam?
I think part of what maybe they're getting to here too is we've always talked about, like, level it out at 8% or 9% or 10%, like have it within 1 or 2%. But the percent, so it's a percentage of income, nominal income. That nominal income increases over time with inflation. Thus, if we actually said, we're not leveling the dollar amount of tax, we're leveling out the percentage of tax based on the nominal income. So when we look at the average plan, the actual dollar amount of tax you pay over time does increase, right? It increases nominally with your nominal income. So that's where, yes, the percentage we want to level out, but the actual dollar amount does increase because, again, inflation does play a factor into financial plans, and that's why a lot of DIY plans don't factor that in. But leveling out, when we look at percentage, the dollar amount does increase over time. So that's maybe what he's trying to get at here, and I fully agree. Like, if the dollar amount, if the amount of tax you pay dollar wise stayed flat, then I don't think that would be a great plan at all. You want it increasing with inflation, just like you want your income and nominal income increasing. So.
Yeah. Yeah.
Define,
and even if it did stay flat throughout the plan, like again, 5 or 7 years down the road, there's going to be enough changes in that plan that it even if it was perfectly increasing by inflation, there's still going to be changes to that plan. Yeah. Sorry, go ahead.
Just like my wife calls me, perfectly imperfect.
I call you one of those things.
Yeah, we won't go there. Jedro 86. I hope to quit my government job after about 25 years of defined benefit pension contribution, which will leave me 7 or so years until I hit 65. I'll definitely want to avoid the defined benefit, bridge benefit, and early retirement penalty. So obviously, if he starts taking it right away, there's a bit of a penalty. I will have approximately 700,000. So he's got some RSPs. Currently, I plan to start drawing my pension at 65 and CPP at 70. Is this something your defined benefit plan clients or other viewers ask you to consider? Well, this is we talked about this a couple of weeks ago on the podcast, and that not all defined benefit pension plans give you a benefit to delay it. Like if he's going to retire, let's say at age, doesn't actually put an age on here, but let's say it's age 60, and there's a bit of a 5-year gap, let's say, well, is he actually going to get more waiting till 65? That may not be the case. So make sure you understand your defined benefit pension plan of when you retire, do I get more if I wait? And is that waiting worth it? Like, even if I get more, is that more worth waiting for? And so that would be the question. Now, again, if you had $700,000 of RSP, yes, of course, if you can delay your pension and get a larger amount and use those years to draw down your RSP, that could be a great strategy. But is there that benefit to delay the defined benefit pension plan? A lot of the times there's not.
Yeah. And it looks like they're considering retiring around 58 because they say it'll leave me 7 or so years until I hit 65. I've seen cases where deferring it until you get out of that early retirement penalty period makes a lot of sense. I've seen cases where the math is relatively close. I've seen only a handful of defined benefit pension plans that I've worked with that actually looked like it was beneficial to delay it well past 65. That was a real curveball. But so do our clients or viewers ask you to consider it? I would say not always, because they're not aware of it. But what you said, Adam, there is do the math on it in terms of how much more are you potentially getting for deferring that. And depending on what that number is, I've had some clients go, wow, this is a no-brainer. I'm deferring it until 63 or 65. I'll stop work, but I'll defer starting it. Other people's like, that, $500 a year more is not worth it. I'm going to start it now so that I know I have that guaranteed paycheck coming in.
If you have the option to delay your defined benefit pension plan and possibly get more, hire an independent financial advisor. And I'm not pushing our services here. We'd love to help you, but hire somebody that knows what they're doing, that can run the numbers, because this could be a $10,000 to hundreds of $1,000 question that you need the right answer to. This is not I feel like this. This is not a feel decision. This is a financial decision that you need to hire a professional to run, because it's not just, again, your silo of defined benefit pension plan. It's your CPP and your RSP. In this case, $700,000 of RSP. Like, there's so many factors that come into this. When I read this, I'm like, this is probably a $200,000 or $300,000 decision that he needs to make. Like, I wouldn't make an emotional one on that one. So again, hire a professional to run these numbers so that you're making the right decision.
Or get the math done and then make an emotional decision. At least you make an emotional decision on based on the math.
What are you teaching our viewers here, Brett?
I'm an engineer. What emotional decisions are there to be made? There are none. They're all logical.
It depends.
Yeah, exactly. It does depend. So Chris Therman? Sure, let's go with that. Chris Therman. In my RRIF, the bank takes a withholding tax on behalf of the government. I understood that was normal. Are you saying there should be an option for the bank to not withhold taxes on RRIF payments? And then a couple other things chiming in here. I don't think there's any way to avoid withholding amount because the CRA wants their money. And don't leave a large amount in your RRIF because your beneficiary will have to pay large taxes on it. So I'm going to just kind of tackle these in the only way I know how, which is just be really picky and detailed about it, which is Can you control the withholding tax? Yes, in certain degrees. So you do not have to pay. You do not have to have the withholding tax on the minimum withdrawal. So I think we talked about this either last podcast or two ago, where if the minimum withdrawal is $10,000 a year, I don't have to remit withholding tax if it's a RRIF. And so I get my $10,000 in my pocket, and I have to make sure that I have money set aside for when I do need to pay those taxes. I'm not getting around paying the taxes. I'm just not having to pay them right up front. So are you saying there should be an option for the bank to not withhold taxes? Yes, within the rules of the Income Tax Act, within the rules of now, whether you want that to happen or don't want that to happen is an entirely different conversation. But the Income Tax Act does allow us to not have any withholding tax on the minimum. The second one is I don't think there's any way to avoid the withholding amount. The comment was don't leave a large amount in your RRIF because your beneficiary will have to pay the large taxes on it. In fact, actually, it's your final tax bill will pay the taxes on it.
Yeah.
The beneficiary doesn't pay the taxes. They might have to pony up some of that money to take care of the taxes, but it's you that pays the taxes on your final tax bill.
But that's a good point. I mean, that's what we stress again and again and again and again on this channel is that you need to be aware that if you're just pulling out the minimum at 72 onward, you're going to run into tax issues. So the RSP meltdown, that's the whole idea. It's creating tax strategy, making sure you don't get like how many, of our parents are running into their 80s and 90s with hundreds of thousands in RSP. And it's a great problem, but it's a tax problem. So it makes a good point that we can't stress enough.
Yeah, I agree. A lot of people talk about estate taxes and, I'm going to pay so much in estate taxes. Estate taxes are usually the smaller portion of the taxable income at death.
Yeah.
Next one there.
Perfect. Woodland NS 689. What time frame before retiring would you set up your cash wedge? 1, 2, 3 years before. And this kind of ties into like when do you start retirement planning? Because if you only start your retirement plan the day before you retire, well, you haven't really built up your cash wedge. That's just the reality of it. So, ideally you want to set up a year or two before, right? Like we've had a good run in the market the last few days, maybe not so much. It's ebb and flow, but we've had a good period of market. So if you're retiring in January 1st of 2026, maybe you've hit it good. Maybe you can, peel some of that back and create that cash wedge, but maybe in 2 weeks from now, 3 weeks from now, markets take a huge dive. Well, maybe not a great time to build the cash wedge, but you're retiring, so you need that money. So I would say a good time is a year or two before. You'll never time it perfectly, and that's not what it's about. It's about kind of start peeling away some of that future income that you're going to need. So my final answer on this would be, I would say 12 to 18 months before you retire. Ideally, you want to start building up that cash wedge.
Yeah, and it's important to remember too that the cash wedge we're talking a relatively small percent, usually a relatively small percentage of your entire net worth, your entire investments. So it's not like we're parking a heck of a lot of money into something that's not growing a lot for a couple of years. We're parking a little bit of money into something that's not growing a lot for the next couple of years, for the insurance of having that money there. I always used to tell clients, I'm going to invest your money like it's 2008 tomorrow. So if the markets go down and it takes certain markets 8 months to come back and other markets 2 to 3 years to come back, wouldn't we want to know that we can weather that storm, having money set up and allocated in a certain way? So I would agree 1 to 2. 3 years is not terrible, certainly. Nope. And if you can't sleep at night without a cash wedge at 5 years before retirement, again, if you have a planner run the plan and say, here's how much you're going to lose over the life of your plan if you do your cash wedge at 5 years instead of 3, I think you'll be pleasantly surprised at what that number is.
Yeah, I agree.
It won't be a lot. It'll probably be worth it if that's what makes you feel good. Laura AW.704, another solid podcast. Much appreciated. Thank you. I have a question as a do-it-yourself retirement planner, single, 66, still working, and will retire earliest spring 2026 at 67 with a defined benefit pension plan. I'm planning to delay CPP and old age security till 70. RSPs are about $200,000, and I plan to melt them down by age 72 until CPP and OAS kicks in. Do I need to put most or all of my RSP investments into a cash wedge now? Just kind of goes to what I was saying just a little bit earlier there, to protect my nest egg from market fluctuation. So actually, Laura states that the plan is to take about $3,000 a month out of taxable registered accounts here, the RSP RRIF. Yep. So based on that, then you would be parking somewhere in the area of $36,000 to $72,000 ish. Even let's just call it $100,000 into a cash wedge. That might be on the extreme side. But so we're not talking about parking it all in there, because you are retiring at 67. You are planning on taking till 72 to withdraw this. So I wouldn't necessarily be leaving the rest of it in the stock market going crazy, because we're only talking about a handful of years here, about 5 years. 5 to 6 years, but I still wouldn't be also throwing it all in cash and avoiding the inflation effects of that. So there's my thoughts on that.
Yeah, and that's why I threw that question and kind of right behind it, to give kind of a real life example of a question that we got from a client saying, hey, here is the timing of the cash wedge. Like, how does this actually work? So no, I think we're spot on there. Next question, is there a threat to CPP and old age security? And this comes from Caroline.Shalom. Thanks for your videos. They're excellent. Is there a threat to CPP or old age security in Canada due to our government? Well, let's just take a step back, and we could do hours on this, obviously, but CPP, the Canada Pension Plan, is well funded. It's managed separately from the government. It has its own investment mandate. It is well funded. It gets independent review on an annual basis. It's funded for over 75 years. So it's in a great position. It's well funded. It's going to be there. It's not going anywhere. Old age security. Obviously, we've talked about this on the podcast. Old age security currently starts at age 65. Back in the day, I think it was 2012, 2011, it was bumped to 67. It got peeled back to 65. I had a client email me the other day that said, hey, I heard old age security is back to 67. So those still float out there. We're at 65. Now, is there a threat to old age security going away? Because that is a purely government funded. I don't see it personally. Again, this is my personal opinion. There hasn't been any talk at all about any changes to old age security in the last little bit. At the end of the day, if the government took away old age security, the reality is that the people that are collecting, a lot of the people collecting that, rely on that money. So now they're relying on welfare or other government funding initiatives. So, it's coming from the same pocket at the end of the day. So I think the one change that might happen with old age security, I could see down the road potentially, is the clawback or the recovery pension tax. That might change a little bit. So it might come lower. So right now it's about $90,000. Maybe that comes down to 50. Like once you hit 50 grand, you start losing old age security, which means a lot more people would lose it. But it's going to go to the people that really do need it. So, none of this has been tabled. It's all just my opinion that if something changed, I could see that's where it would be geared to. But yeah, nothing on the table at this point.
Yeah. And I remember like 10 or 15 years ago, there's a discussion about, is CPP going to be okay and things like that? Because the general idea with a pension plan is that you have more people contributing to it than people that are drawing on it. And therefore, the people that are contributing to it are supporting the people drawing on it. And then when it comes their turn to draw on it, the same kind of thing. And that obviously got flipped with the baby boom and things like that. I, for one, have a lot of confidence in the CPP for the reasons that you just mentioned. I do suggest people Google Canadian Pension Plan Investment Board, or CPP-IB. They put out an annual statement each year, and it shows, the rate of return and things like that. I think it's one of the best managed pension plans out there, if not the best, and one of the cheapest ones to buy into. into, certainly. Old age security, yes, it could be, they could change the test on it. One of my original financial planning mentors, Rick Pryor, once said, I wouldn't be surprised if they change it from an income test to an asset test. Yeah, I can see the test on old age security potentially changing if we ever get to that point. CPP, it'd be interesting to see what would happen to the government, that decides that, hey, we're going to, really start to affect or take away CPP.
It's something we paid into,
what that
right?
would look like.
Yeah, no, it's something we paid into, and I think they saw, we've had changes the last, from, what was it, 2019, 2023, I think it was. We saw changes. We're paying more into CPP than we ever have, right? So, that's part of it. Now we're also going to get more out, right? It wasn't, hey, we're going to pay more in and get no more out of it. We're paying more in to get more out of it, to create more sustainability for retirees. So there's pieces to it, but it just shows you how well managed. Hey, CPP is not actually providing enough. You're getting some out of it, but we want to enhance it. Anyway, we won't go into that deep hole here, but I think both are here to stay. There could be a bit of change to old age security in the decades to come, I would say, but I think both are they're staples to Canadian retirement income. At the end of the day, CPP and OAS are a huge part of most people's retirement income. For a lot of people, that's their only income. So I wouldn't expect much change there.
Yeah. Holy mackerel. Gargalis 6388. How to avoid the tax? How to avoid paying tax on your RRSP account after death? My cheeky answer to this is don't have any money in your RRSP account or RRIF, because at the point
live till 130. That's the solution for everybody.
Yeah. Adam's sitting there in the back of his mind thinking, this guy actually talks to my clients and says, hey, just don't have any in your, this is Brett's advice. Don't have any money in your RRIF. Done.
Just get rid of it.
Okay. If we pass away with money in our RRSP or RRIF, it's going to get taxed, and it's either going to get taxed on death. It's going to get taxed after it rolls over to a common law partner or spouse and they withdraw it, or after their passing. So now there's a couple of if-ands around that in terms of passing away and moving it into potentially an RDSP. When we're talking about a disability in the family or beneficiary that has a disability, but I'm going to talk about what I think happens to 98% of Canadians. So really it's about how much tax do we pay now while we think we're going to be alive versus what the tax will be when we pass away. And if somebody passes away with $200,000 in an RRSP or RRIF, they're going to be taxed as if they made $200,000 that year, plus any other taxable income they had that year. So if you pass away January 1st, that's one thing. You pass away December 31st, that's another thing. But that $200,000, $100,000, $150,000 is going to add to your taxable income, and it's going to be taxed all in 1 year, not over 5 years, not over 10 years. So the only way to do it is to figure out, how can I reduce the amount of taxes I'm going to pay on this money? Because I didn't pay taxes when I put it in. I got to defer the taxes. So how do I reduce it, not avoid it? I can't think of a magic wand that says, oh, here's one way to avoid it.
I'll say this, though. It's never too late. We do a lot of plans for clients' parents in their 80s. We've done a lot of plans actually over the last year for people in their 80s that, didn't do any planning. And, the kids are now saying, Mom, Dad, you guys are 85. You're not going to be here forever. And you still have $800,000, whatever the number is, in your RRSP or in your RRIF. We need to deal with this. And so, better late than never. It's better to kind of spread that over, say, 3 to 5 years versus all being lump sum in 1 year on death. So, but that's why we stress the RRSP meltdown is, how do we melt this down before you are expected to die? And no one knows when you're going to die, but there's statistics out there that we have to work off of. I think a lot of people that are concerned, and I know this because I talk to you guys on a daily basis, a lot of you that are concerned of dying with an RRSP and paying all this tax are the exact same people that are taking their Canada pension plan at age 60. And so these two things really work against each other. It's like the opposite sides of a magnet, they push against each other. One of the benefits of delaying CPP is that you now give yourself time to strategically draw down your RRSP or your registered accounts. Like those two things really do work together. So that's where having a plan, understanding these concepts do work. But if you have a family member that's in their late 70s or 80s, 90s even, and they have a large RRSP, it's not too late to get a plan. Like you can still save tens of thousands of dollars in taxes by using at least the few years that they may have left. So, yeah. So on to the last one here for today. This is from Mindyepe. I'm going to say it that way.
Sure.
Thanks for breaching the topic of bonds versus bond funds, which is, a hot topic. I'm very confused on this topic because there's so much discussion on owning bonds, i.e. 60-40 split, but very little education on doing so. When I ask questions on this topic, the answer always seems to be simply buy bond funds, but these don't seem to offer the same stability as owning bonds. Bonds are sold with a predetermined coupon paid regularly with a promise to return you your original investment. Well, there's no promise to return. That is a GIC or high interest savings. There's no guarantee. Now, if you buy a good quality bond, the chances are, yes, you will probably get all your money back and collect the yield along the way. Mm-hmm. One of the issues, I'll just say this, for 95% of Canadians, it's really difficult to buy an individual bond. We've come across a few clients that have figured out how to buy it. Individual bonds typically held, for the private investment counsel firm, private wealth firms, more of the trading style. For your average Canadian investor, it's very difficult to obtain. And I won't go down that rabbit hole here either. But for most of us, bond funds is kind of what's available to us. That's one thing we refer a lot of clients to a firm, BCV, Blue Chip Value. One thing we like about them is they do buy individual bonds, and we see the value of that. So yes, for your average, bonds versus bond funds. Unfortunately, for most Canadian, bond fund is, if you want bond exposure, that's the best way to go. If you can find a portfolio manager that's able and willing and knows how to buy bonds and how to manage that, it can be a great solution. But again, it's easier said than done for sure.
Yeah, and the bond funds are going up and down for more or less the same reason that in a stock fund, a stock index fund is going up and down, is that at that moment in time, it is deemed to be more valuable or less valuable, just for one main reason is what the value people are putting on it. Like in terms of RBC, you'll see RBC stock go down. It's not because RBC is about to go bankrupt. It's just because something's going on in the Canadian economy or the financial industry or whatever, and so it's gone down. So I would agree that buying bond funds is not a terrible idea. It's neither good nor bad versus the individual bonds. And as you said, it's a little bit easier. And one thing I want to mention here too is that when we talk about bonds or people talk about bonds, we're mainly talking about fixed income, which is a subset. Bonds are a subset of that. And it was traditionally bonds and stocks. That's what you invested in, bonds and stocks. So that's still the conversation that we're hearing. Maybe it's better to talk about lower volatility versus higher volatility, gains and growth versus, yes, get my money back with a little bit of return. So when we're talking about bonds, we're talking about that less volatile aspect of your portfolio.
Exactly. Yeah. And there's alternatives out there. Like, we're not going to get into that on this podcast, but, if you can only buy bond funds and you really don't like bond funds, there's other options in that kind of safer space when you're looking at your asset allocation. So what we saw this week, I've been very excited about this. I think every Canadian should be. And it's, there wasn't a whole lot in the federal budget released on the 4th that I got too excited about other than this. But it's bank fees being removed as part of the federal budget, and bank fees and transfer fees. So right now, let's say you have money at any financial institution at the end of the day, whether it's a big bank or otherwise. When you move that out, so if you transfer money out of TD, let's say you transfer out your RRSP, they're going to ding you on average around $150 just as a transfer out fee. They used to be called convenience fees, and I don't know how you call a fee a convenience, but we see it all the time. And you know what? Sometimes if you move from TD to RBC will reimburse you the $150. And it's this big cat and mouse game that's happened in our industry for decades on decades. That is apparently going to be going away. And financial institutions will no longer be able to charge transfer out fees. So that's a great thing. Now, do they put fees on annual fees? Do they do something else? Maybe. Yeah, the banks are smart. They'll figure ways around it. But for now, transfer out fees. There's also going to be a push on a timeliness of transfer. Right now, Brett and I deal with this all the time, our transfer team internally all the time, in that sometimes the transfer will take months on months on months. Like we you know, the transfer form's been sent out and it's sitting at, let's call RBC for months on end, and they're just sitting on it. It's like, release the funds. Like the client is not getting what they want to get. But there's no requirement for them to release it in a timely manner. And that's going to be changing as well. So as far as like, as people look to transfer their accounts or make changes, especially as they get to retirement, I always say, like, you may need a different financial planner or investment person to walk you in this different phase of life. You may need to transfer your money. You may need to do things differently. But right now, if you have 10 accounts, there's a $1,500 transfer fee. Again, a lot of firms will reimburse that, but it sounds like that is going to be going away, and transfer is a lot faster. So 2 great news. I know it's kind of behind the scenes things, but this does affect all Canadians.
Yeah, and if I remember, unfortunately, it's not going to happen tomorrow. I think they are going to be publishing probably like a review paper draft or something like that. And I believe that was late 2025, early 2026, something like. So this is not going to happen overnight. If I had to guess, maybe by the end of 2026, but I think it's moving in the right direction, because as you stated, it's a charge per account. I transfer out my RSP, that's $150 or 50 or 75. I transfer out my non-registered account, I transfer out my TFSA, bang, 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 bang. I've got a locked-in account, there's another one. So,
and Wealthsimple was actually, I'll give them credit. They were a big push behind all of this. They were from day one.
Good.
You know, I remember, like, we were on their advisor platform many years ago, decade ago, and this was their big thing. Like, hey, if your client's not happy, they can transfer it free of charge. You know, when we get a transfer form in, we send stuff out, the money out really quickly. Like, they've been really big on change on this. So it's nice to see a big institution like that, who manages $100 billion now, really push behind that. So
yeah, absolutely. Last one here, tip of the week, capital gains tax on commercial property. This is from Sam Hunter 3249. What's the saying? Death and taxes. They start. I have a question. My dad passed away this March and left my mom a commercial property. They bought 30 years ago for $350,000. The current valuation is over $2.5 million. The property is triple net lease, long-term tenants. So we're going to keep it. My mom is 91 years old, and I was going to ask my accountant, when my mom passes and I keep the business running, will I have to pay capital gains within the same year my mom passes? Can I defer capital gains till I sell the property? And a couple other comments down here. Taffy XU 3BM, simple answer to your questions, yes and no. And I would say not that simple. And GTTM1FT, for the love of God, don't rely on our opinions or something is so important and possibly complex. Retain a competent professional and don't listen to the noise. We should be hiring that person to answer all of our comments.
Exactly.
So okay, here's where I get to use it depends. Yay, it depends. So if that commercial property is inside of corporation, then that things are going to happen differently because the corporation is a distinct identity. What am I trying to say here, Adam?
Identity or individual.
Yeah, yep. Entity. There we go. Distinct entity, which I don't want to say doesn't have anything to do with when your mom passes away, but it's a different story than if your parents own that and now your mom owns it personally, and then she passes away. Quite frankly, I can't see an option where that the capital gains will not have to be realized because it's a deemed disposition and being transferred to somebody else. Given that you're talking about a business and all those type of things, I'm guessing it's inside of a corporation. I don't want to guess. And yes, sitting down with your accountant and your financial planner, but I'd certainly start with your accountant and say what happens when mom passes away, and then start to put a plan into place to try to deal with or mitigate any of these things.
Yeah. And the same thing happens when like vacation property, cottages, commercial properties like this is second use property. Anytime there's an asset that's not your principal residence, there's the potential and really the reality that there could be and will be a tax bill down the road when the ownership of that asset die. Obviously, yeah, you can shelter some of this in a corporation, shelter the tax bill, shelter the ownership, all of that. But the government's going to get their money eventually, right? And so this is why some people own, like a lot of times we've seen corporations, insurance policies. So yeah, when mom passes away, we had an insurance policy, maybe a joint last to die. So when the second of them pass away, there's a $1 million, $2 million, $5 million, whatever the property gain is worth, pays into the corporation or pays personally if it's owned personally. The insurance pays the bill, but the property is retained. So again, this is where a lot of estate planning has to happen. If you own your commercial property, second property, vacation property, anything like that, like what is the future need or want of that property? If it's to keep it in the family, well, there's a tax bill that's going to be due. So where is that money coming from to pay the tax bill? Something that a lot of people don't think about until it's too late. Some people do estate freezes. There's other, tools or strategies that you can employ. Again, talk to your accountant, talk to your financial planner about that to see what the best strategy is for you. But yeah, if this was personally owned, yeah, there's tax to be paid, and that's just the reality. So it might have to be sold, which would be too bad because a lot of those properties, if it's pumping off good cash flow, hard to sell that stuff sometimes.
Yeah. Also talk to your accountant about paying that capital gain over a 5-year period. There is strategies and methods allowed in the Income Tax Act that allows you to spread it out, not perfectly 20% each year times 5. So there's a lot to start with your accountant. There's a lot to talk about there to understand how it's set up and what will happen, and then put a plan together to try to lessen any impacts of that.
Absolutely. Yeah. Perfect. Well, thank you for joining us. We have about 260 questions that we have in our database. I think we've answered maybe 60 of them. So I might do a couple separate YouTube videos coming up over the next few months to answer more questions outside of the podcast as well. So stay tuned for that. But Brett, we'll see you next week. Thanks for doing this one again.
You bet. Take care. Thanks, everyone.
Thanks for joining us on this week's episode of Retirement Unpacked. If you found today's conversation helpful, don't forget to subscribe so you don't miss next week's episode. And remember, the ideas we talk about are general in nature. They may not fit your personal situation. Always consult a qualified financial planner before making decisions about your retirement. Take care, and we'll see you next week.